Hello and welcome everybody to our home equity webinar. Long-term secular trends are moving us towards more home equity transactions. Nested equity is at historical highs. There appears to be a mortgage rate lockdown, although I think our Logan Modashami would disagree with that. Average home ownership tenure keeps rising. Older generations want to age in place. And that longer tenure and aging in place mean more home renovations. I have an all-star panel today to discuss the opportunity in home equity. We're going to start with a quick chat with Marina Walsh, VP of Industry Analysis at the Mortgage Bankers Association. Then we'll have a panel discussion with Marina and three industry experts: Craig Austin, Chief Revenue Officer at First Close; Jackson Braswell, Director of Credit Administration and Collection at Truliant Federal Credit Union. And we'll also have Kevin Waltz, Mortgage Sales Manager at Associated Credit Union. As always with our virtual events, we want this to be a dynamic and engaging conversation, and we hope that our audience will ask plenty of questions. You can ask a question by clicking the Q&A button in your Zoom screen, or by just dropping the question into the chat. So let's get started with Marina. Marina, welcome again. The MBA recently released your home equity lending study after a one-year hiatus. Why did you take a break with this report, and why did you bring it back?
Well, if you think about where the originations market was 2 years ago, we were in a period of low interest rates, incredible refinancing demand, incredible volume there. So home equity definitely took a backseat for a lot of lenders. In fact, during COVID, some large lenders got out of the home equity business. There was simply so much business in terms of purchases, cash out refinances, regular rate term refinances. So there simply wasn't necessarily that big of a demand for the home equity product, but that certainly has changed. We saw the writing on the wall. Given all of the interest rate increases over the past year and a half or two, it made sense to bring back this study.
Yeah, I love that you did, and I'm seeing that same interest and engagement from the HousingWire audience. So let's dive into this recent report. What are some of the highlights that you want to share with this audience?
Well, one of the highlights, because we have conducted the home equity study over a 6-year period, so we at least have every other year volume information, is that compared to 2 years ago in 2022, home equity volume and home equity line of credit volume basically doubled in our study. So this is based on about a little over 20 companies participated in the home equity study. Most of them were banks. In fact, all of them were banks. And I know there is interest among the non-banks in the independent mortgage banker space as well. But we looked at it on a repeater basis, and we sort of reached a low in 2020, got out of there and saw much more interest, higher utilization rates on the HELOC product in 2022.
I think you have a recent chart of the week that highlights my earlier point about longer home tenure, aging in place, and renovations. Just want to give a quick shout out to that chart of the week. I don't know if you have any additional thoughts on it.
Absolutely. I mean, we're at this point in time, everyone knows we have a huge housing inventory problem. And a lot of it is related to these existing homeowners who don't want to lose their first, their very good low mortgage rate on their first. And so they're looking for alternatives, whereas before they might be a move up buyer. They're now considering, gosh, maybe we should stay put. We have our first mortgage already at this very low rate. So as they expand their families, as seniors want to age in place, it creates an opportunity for renovation. And so based on our study, in terms of the reasons for getting a home equity loan or a HELOC, The primary reason was home renovation. That was in 2/3 of the cases for the known reasons for getting one of those products. 2/3 was related to renovation. Another portion, a sizable portion, 1 in 4, related to debt consolidation. So that's important to keep in mind too, especially as you see these balances rising for credit cards as well as car loans. There could be potential in that space too. Going forward, as borrowers want to consolidate their debt. This could potentially be an option for them. Obviously, credit cards are at a higher interest rate than would be a home equity product.
Definitely an interesting opportunity, business development opportunity related to home equity. And we'll put a link to that chart of the week into the chat. And why don't we also bring the other panelists on while I ask this final question of Marina. Over the past year, we've seen a decline in home equity transactions with this big spike in mortgage rates that we were talking about in the prep before the call, and really everyone's talking about. What are your expectations for home equity in the rest of 2023 and then for 2024?
Well, first of all, I think there are a lot of opportunities, as you said. But first, in terms of the home equity study and what the lenders say, which is probably even more important than what Marina Walsh says, in terms of debt outstanding for HELOCs, they're expecting those debt outstandings to go up by 10%. Both between 2022 and 2023, and then into 2023 and 2024. We had a smaller sample for home equity loans, which again is, obviously it's at a fixed rate, different product than a HELOC. But their expectation in 2023 is a 9% increase in debt outstanding. So that's important to keep in mind. I think a lot of it in terms of opportunity, what happens in this space may be dependent on what happens in the securitization market. You have banks that can hold these loans in portfolio, but there are balance sheet constraints. And given the events of this year, there could be more scrutiny of the boards in terms of community banks and others holding loans in portfolio. So you do see some non-bank players getting into this space. There have been, I believe, about 20 maybe it's more like 14 securitizations over the last 3 years. So there is potential, there could be some investor interest there, but obviously it's all a matter of how it's structured, because especially with a HELOC, unless the fundings are taken, a borrower uses their HELOC at the point of origination, it's hard to really determine how much of the HELOC is going to be utilized, which I think is one of the challenges for the securitization market. But right. Lots of opportunity.
Absolutely, and maybe that may be a challenge in answering this question that just came in. When you looked at how home equity lending transactions are used by the borrower, was there any breakdown in the types of renovations that people are pursuing? Kitchen, bathroom versus room additions versus other issues?
Unfortunately, we don't have that breakout, but I'm going to put that as a note to potentially add next year additional breakouts for reasons for the remodeling, whether it's a whole addition versus a bathroom or a kitchen or an office. I'll see if our lenders are able to provide that to us.
Yeah, really good question, Will Johnson. Would be really interesting data to look at. All right, now we've got the rest of our panelists here. Thank you, Marina, for walking us through the report, and we've also posted a link to that report in this Zoom experience. So, Marina, hopefully you'll stick around and join the panel while we talk through stuff. But I wanted to go over to Craig with this question. Craig, you've got a big client base that's pursuing home equity lending, so you're able to look across a lot of activity in the home equity space. What are you seeing in your client base right now? Are your customers leaning in? Are they leaning out? Or are they kind of holding steady? I'm sure it depends from client to client, but would love your view.
Yeah, I would say it depends client to client, but also region to region, right? A little bit. I would say if you were to ask me that question 3 to 6 months ago, I would certainly say that we're at more of a wait and see what's going to happen because of everything that was occurring during that time period, obviously, with deposits and cash flow concerns, everything else that went on there. That people are starting to get back into it, definitely looking at technology more and how to be more efficient. I think that's the biggest kind of visual that I've noticed is that people are understanding that they might have to do a little bit more with less. And that's what it means how much cash do they have available to lend to these borrowers. So as lending requirements stay pretty strict on the home equity side. But as like Marina said, as demand increases, as debts increase, right, and people need to either leverage their existing home equity loan or take one out, we're going to see that balance. There's always been this battle between cash out refis and home equity loans, right? And obviously, rates generally, when they go up, that usually means that's good for home equity loans, right? That you're going to see more of those. But rates have gone up to such a degree in the past 12 months that it's actually harming a little bit there as well. So there's this sweet spot for home equity loans where it's high enough to where people aren't going to do cash out refi, but not so high that it's like, this is nearly close to what I'm paying for my credit card debt. Why would I do this? There's that balance. So I think as we see rates go into the sixes later on this year, hopefully, and into 2024, we're going to see a little bit more demand is what we're thinking. But like I said, that's going to be region by region and client by client in a lot of ways.
So it sounds like that is your expectation for the rest of 23 and early 24. What are you expecting for the next couple of years overall for home equity? It seems like a lot of the signs point towards this being a growing business.
Yeah, I think like Marina said, as liquidity becomes more clear on that end, as lending requirements loosen up a little bit. I mean, we have lenders that are doing decent volume, but still have over 720 FICO requirements, under 80% LTV, still pretty strict there. As those loosen up, as demand increases, as liquidity becomes less of a concern and people, deposits increase and things get a little bit clearer there, I do think there'll be an increase. We did not see that generally April, May, June, we see that spike, a little bit of a hockey stick, like everywhere else in the mortgage industry, really. It was pretty steady this year. It was up a little bit, but we didn't see that hockey stick. So we're thinking we're going to see that steadiness through the end of this year. Obviously, the normal winter decline, and then things start to pick up again March, April, May in 2024.
So interesting. So now I'll bring in Kevin and Jackson, who respectively run home equity lending for Associated Credit Union and Truliant Federal Credit Union. Kevin, I would love for you to tell us about your home equity business at Associated. How is the business structured and what kind of volume are you doing right now?
We are a small credit union, being $2 billion in size, but I like to think of us as small but powerful. We have grown our equity line business over the last 3 years, and I have one lending team with one equity originator, one processor, one closer. I am very lucky in the state of Georgia that I can close equity lines in our branches. If I don't close in a branch, I have to close with an attorney. So I have 15 branches that I can help or that help us with closings. So we have taken this on the last 3 years and grown it where we were doing 30 to 35 equity lines a month. Now on an average basis, about 65 to 70 equity lines a month, about $4 million to $4.5 million on a monthly basis. We're conservative. We're a credit union. It's a 680 credit score. It's an 80% loan to value. If they have that first mortgage with us, we can go up to 85%. You do have to be a member. Some people think that's hard to do. It's not. If you're in the state of Georgia or if your business banks with us, it's $10 to join. We always want more. We're greedy. We want to have the full relationship, but again, small but powerful and do a good job of what we do.
So I'm going to there's a question that just came in that I'm going to hold until after I ask Jackson the same question I just asked you, but I think it's a really good question that just came in from the audience. Jackson, how about you? How is your business structured, and what kind of volume are you doing right now?
Yeah, thanks for that, Diego. Appreciate the opportunity. We are structured a little bit differently than Kevin and his group. We have 10 currently. We have 10 home equity processors, and we managed to roughly a $55 million pipeline with currently about 600 applications in process. So our volume is, we are a volume dealer, so to speak, with our membership base, and we're currently trying to run to those efficiencies, like Marina was saying earlier. The unsecured market is good. We're seeing a lot of that consolidation, so we're trying to operationalize our home equity department to mirror one of a mortgage department, where we have a desk mentality. In other words, we're not looking to have processors carry the loan from application to funding. Really trying to efficientize that operation. So we're currently in the process of making that happen, and we will go up to 85%. We were up to 90% on our line of credit products last year, but as we continue to go into the where we are with the state of our current economy, we have dialed that back to the 85% mark across the board for line of credit and closed end.
So is it fair to say, and this is a question for both of you, for both Jackson and Kevin, is it fair to say that you throttle the business using those credit requirements and loan to value? Is that how you kind of keep the balance?
I'll say yes. It's again, as we talked about a little bit ago, it's a battle between that cash out refi versus the equity lending. With mortgage rates the way that they are, the cash out refi went away, especially when you put the LLPAs on there, driving people to do the equity lending. And then we just look at it as to what the economy's doing, and what the Atlanta area or the state of Georgia economy is doing, to give our loan to values and our credit scores.
Yeah, I'd jump on the point that Kevin made there. I mean, I think that those are easy levers to pull, right? You can easily control production through things like beacon score requirements, LTVs, things of that nature. That has shown over time that we're able to really stay in the lane in which works well for our members and also organizationally.
Yeah, Jackson, I want to stick with you for a moment. This sort of mirrors the question that we got in the chat. But you highlighted during prep that we did, you highlighted the people-oriented culture at TrueLiant and mentioned that you don't want to hire to fire on your home equity team, which I think is a great approach. But does this mean that you also miss some opportunity when the home equity business is booming?
I don't like to look at it like we're missing opportunity. I think it's easy to run to the volume. If you want more, if you want to put that, those dollars on your books. But historically, this is not, an even keeled space to be in, right? There are ebbs and flows to it, and you have to answer those questions in the downward turns, and we're just not real comfortable doing that. We found like I said earlier, we found a place that works well for in production and the volume, that works well for the membership, works well for the organization and our employees. So we can turn the juice on and off as we need to, and we'll stretch from time to time. But we really like to stay in that lane, and not lose sight of what we do well. And we do a lot of good with these loans and providing a wide variety of loan types for our members, and we really like to be good at doing what we do.
Yeah, that makes sense. Kevin, I'd love your thoughts on that as well. You seem to take a similar approach to Jackson with hiring.
Yes, when times are good, you always want to add more. but we all know that the equity business is on an ebb and flow during the year and over the years. So we are very happy with the one team that we have. If I need extra staff to work into there, we can take someone from the mortgage side, bring them over to the equity side to help out during that period of need.
Yeah, that makes sense. So Kevin, I want to stick with you for a moment. Over the past couple of years, we talked about in our prep session that you've been able to drop your time to close for home equity loans from somewhere in that 45 to 50 day range down to 14 to 21 days, which is pretty remarkable change. How did you achieve this improvement in closing time?
A couple of different things. One, we started using Meridian Link for all of our loan processing in setup, where the members can go online, put the application in. It takes 15 minutes to do so. Very simple to do so. Then we partnered up with Greg and his group at First Close. One of the best partnerships that I've signed up with, where I can go in, take that application, push the First Close button. I'll have my flood. I'll have my AVM immediately, and I'm going to have my title report generally back in a couple of days. That takes you down to your closing time period. You know, if it's a good, clean loan, that's a 10 or 14 day close. The only reason we have an extra couple of days on there is because we're going through branches and we're setting up with the member to go into a branch for 4 wet signatures. Everything else is automated where it's sent to them. They can sign everything via DocuSign. How we changed that is we had been sending everything to attorneys, to do our title work for us and do our closings for us, do our paperwork for us. That worked out well, but equity lines got put at the end of the line. They're going to close their mortgages first before they did the equity line. So we brought it all in-house using First Close and Meridian Link, and just been a great process for us.
Jackson, you're also seeing some pretty good improvements in that time to close metric. To the extent that they're different, what are the things that you did to improve those time to close?
Well, again, following up Kevin and his infinite wisdom, that the time spent now is chasing the member, right? When we too use Meridian Link and also First Close, and I couldn't agree more with Kevin's remarks earlier. I mean, when you're able to push a button and get your flood cert, get your AVM, whether it be a condition report or a desktop valuation or even a full appraisal, and not have to go through the regulatory red tape with appraisers and First Close is handling all that for us. I mean, I was discussing with my home equity manager the days, and we had shared with you the 35 to 30 to 28 days, and she corrected me pretty quickly, and she said, in queue days are 11 for HELOCs and 14 for closed-end loans, and that's a built-in rescission period there, right? Too. So First Close has really given us the ability to free that up and really chase and have those purposeful conversations with the members and get all the required documents that we need. But from an efficiency standpoint, couldn't be much better from what First Close offers us.
Yeah, Marina, would love to pull you in for a moment here. It sounds like the time to close that Jackson and Kevin are seeing are pretty different from the averages that you're seeing across the industry, and different in a good way. So do you want to talk a little bit about what you're seeing in your averages?
Yes, absolutely, Diego. So for this group of, again, about 2021 lenders, we were looking at days from app to close for HELOCs of 41 on a simple average basis, and then 47 for closed-end home equity loans. And I think the key to it, of what I see between those that are on the low end versus the high end, really has to do with the underwriting and whether there's reliance on AVMs versus desktop valuations versus full appraisals. Because believe it or not, in our study, 1 in 5 borrowers still goes through a full appraisal. So you're talking about a time from app to close that's closer to a first mortgage, which is around 48 days, based on other studies we do, and that's for banks and independents combined. So, as that moves up, and there certainly is movement over the years in terms of the percentage that are handled through AVMs. Now it's sitting at about 42%. In 2018, it was about 32%. But still there's room to grow. Desktop valuations being the remainder 26%. So definitely room. You hear about all this technology out there, artificial intelligence. It's a whole new frontier out there in terms of getting, reliable data to make underwriting decisions. So,
Greg, I think this is a good spot to pull you in on. It seems like you've got two clients here who are having some success with that time to close metric. What do you think is important when it comes to improving on time to close and really kind of borrower satisfaction?
Well, I think it's twofold. It's how are you the individuals coming in, the borrowers coming in via, whether it be through a proprietary application, through obviously first close, point of sale, or any other, how are you filtering out those borrowers, right? Are you spending time on applicants that have a low rate of success? And that's because they just don't have the home equity there, but you're still ordering AVMs, you're still putting bodies on those borrowers to then obviously wasting time on the actual loans that actually are going to be pulled through and funded. And then it's the back end. And it's a lot of what Marina just said, and a lot of what Jackson and Kevin said too. It's what are they ordering? We have clients that rely honestly on the tax authority, right? And what the value is there. You have people that are leveraging AVMs. You have people that are leveraging desktops of full appraisals. Again, we do see it as well. A lot of people are still leaning on full appraisals for their decisioning. When you have something like first close, an ordering system that can automate and say, hey, we're going to pull an AVM, but the confidence score isn't high enough in this AVM, so then we're going to go to a desktop. So you have that natural progression to individual products, and instead of just saying, hey, we're looking at tax assessed value, oh, it's not there, let's go right to a full appraisal, right? And now that takes 11 to 15 to 17 days, whatever it might be, to complete. That can really obviously extend those times out. So it's both filtering the upfront borrowers and then obviously the back end ordering.
So a lot of chatter in the chat about first close HELOC versus first lien. We are with first close today. First lien HELOC versus second lien HELOC. I guess throwing this to Jackson and Kevin, do either of you do first lien HELOC at your institutions?
Yeah, we do. Depending on what the purpose of the loan will be, they're priced accordingly, and carry with the associated risk with each type of loan. But we do go into first position with a HELOC product here.
And we will also, not for a purchase, but if they own the house outright, sure.
Marina, another request for data in the chat as well. Folks are interested in performance and data on first lien HELOC versus second lien. I don't know if that's something that you looked at in this recent report.
Well, in terms of performance and breaking out delinquencies, if you mean that, I don't have that, but I do have, of the volume coming in, the portion that's related to first lien versus second lien. So first lien is about 30% of the volume, the commitment volume we have coming in. So that doesn't necessarily indicate that all of it is being funded, but 30% altogether, and that includes home equity loans as well. The split is probably 25% of the total is HELOC first, and then about 5% is home equity loan first. So, definitely potential. There are those out there, that may consider this instead of a reverse mortgage. Again, I'm thinking about my 84 or 85-year-old mother. I'm not crazy about her getting a reverse at this point in time, but she has plenty of equity in the home she's been in for over 30 years. And so that could potentially be an alternative.
Craig, what are your thoughts there?
I 100% agree. We talked about that sweet spot, right, between the cash out refi and doing a HELOC, and then how rates are even gone beyond that at this point. Without a doubt, we're looking that's people that are, there still are these situations where whether it be divorce or a death, or just looking at a reverse and later on in the career and retired and looking for some extra money. You have these situations that are putting people in these very unique positions, and so home equity loans obviously are that if we inform the borrower the right way and give them all the appropriate paths, it can push them in that direction, because it's the equity's there and the rates pretty good and decent usually, and they can qualify. So if that's the best option for them, as opposed to pushing them to a reverse or the other way, refining their first when their rate will go up 2x, then it's a positive path.
All right, we're going to go off road a little bit because we got a lot of audience questions coming in. So hopefully this is okay. Will Johnson again with an interesting question. Thanks to the recent home value appreciation that we've seen, LTV doesn't seem to be an obstacle so much as DTI can become the hurdle. So he's interested in learning from Jackson and Kevin if they're looking at alternative valuation models or ways to accommodate DTI becoming the hurdle.
DTI, is a hurdle. You had a lot of people since 2020 that went in to be self-employed. Self-employed is a bad word. It's hard to get that income and improve that income based on a short time period that they have been self-employed. That, or if they file late tax returns, being October, where you're going 2021 right now, you haven't even got 2022 to look at, and then you're looking at 1099s for 2023. We do get a little bit more conservative. So I see debt to income as being an issue, but our 43% is generally covering the vast majority of the people that are applying here, at least at Associated Credit Union. What I run into a little bit more than that is credit scores. You get that when it's below the 680, and that's where we really start. We'll go a little bit below that 680, but we do not like to get much below that. It's that really seems to be more of a problem or an issue than DTI, at least here.
Yeah, I would agree. I would agree with you there, Kevin. We will go down to 640 in our home equity portfolio, depending on we can get a little bit lower than that, but it would depend on the scenario. But the riskier it gets, the higher the DTI gets. That's when we really start controlling the narrative with the LTV. We may not max you out, really trying to control that, because obviously we try to keep our mission at front of mind every day, which is making sure that we're putting our borrowers and our members in positive financial positions. So those are the kind of levers that we pull, when we start when things start getting a little tricky.
And Diego, on that note, in terms of FICO score, just to provide some other averages out there, 769 was the simple average for HELOCs in our study, and then 752 for home equity loans. So it seems like it's tight in terms of the credit box, at least based on our sample of companies.
So are either of you gentlemen, Kevin or Jackson, looking at alternatives for self-employed, like bank statement loans, or you're not heading down that path just yet?
We aren't. Yeah, we are running our cash flow analysis and really trying to make responsible decisions as it relates to how that member is set up, in their tax return, right? Or you can either report your income and qualify for loans, or you can take the tax breaks and advantages and not show the income, and then unfortunately you may not qualify for the loan.
I'm right there with you. It's if they're looking for a non-QM, I'm not your guy. I'll send you to get a non-QM mortgage out on Angel Oak or somebody. That is not our space.
Understood. All right. So another question from the audience. and this is for the whole group. What are your thoughts on some of the new technology where we see HELOCs underwritten in 5 days, as opposed to the fully underwritten home equity solutions that I think the two bankers on this call are offering. And maybe I'll start with you, Kevin, and then we'll just kind of go around the horn here.
I don't have a delay on underwriting with my underwriter. I got one sits in the office right next to me. So typically, if they get get that application completed and we turn in underwriting, I'll have it turned around in 48 hours or less. Most of the time, 24 hours or less. Would I like to see automated underwriting where I get instant approval? Yes, on some of them, I think we should. I mean, if you're looking at a 30, 40, 50% loan to value and a debt to income well less than 40, I mean, what did I say? Go back 40, 50, 60% loan to value and debt to income less than 40. Sure, we ought to be able to do some decisioning, maybe up to 50, 75, $100,000. And I know that with Meridian Link, we're looking at a couple enhancements next year, and that might be something we look at.
Yeah, and we've actually got an existing relationship with artificial intelligence model on our consumer side, and we are really in the infancy stages of exploring what they can do for us on the home equity side. We've got service level agreements and underwriting too. I've got 6 or 7 consumer underwriters, and we need to be turning those decisions around in a couple hours. So it really is, all the products and everything that Craig and his crew can bundle together for us. It's really just a question of whether or not you can get comfortable using those valuations and trusting in your partner the information that they're returning to you.
That's the biggest thing, Diego. We have a pretty wide customer. We have banks, IMBs, credit unions, smaller regional base, national. It's what Jackson just said. It's some people are just more comfortable jumping into the pool, and some people want to dip their toe in, right? So everyone's a little bit different. It's how much confidence you have in your ABM vendor. It's how much confidence you have in your other vendors that you're leveraging across all those other product suites that we've been talking about. But you have certain institutions that are trying to push through, close 1,000 HELOCs in a month with, a regionally based shop, and they need automate. They don't have a choice. If they wanted that kind of volume, they have to have automation. It would not be sustainable from a body standpoint. And then others that are saying, this is my footprint. This is what I want to lend in. I don't need to overextend myself. So I'll just, keep dotting my I's and crossing my T's. I don't need automation. So it's a wide spectrum there. And that's true even as you go into, Ron in the first mortgage space, right? We're still trying to squeeze that lemon. It's even more so in the home equity space, right? I mean, people don't feel comfortable yet going into that area.
But Craig, I imagine from a technology perspective, which is where you play, you have to think about both of those scenarios. Yeah. So are you thinking about that more automated scenario as you build the tech at First Close?
Without a doubt. And we have it all there. And we do, just so everyone's understanding correctly, we do have customers that go full end-to-end, full digital experience. They can do that, right? But a lot of times people are fearful that they're losing that, the member experience throughout that process, right? If you go full digital, they're not coming into the branch. They're not talking to anybody. You're not walking them through what the best loan programs are for them. You're not talking about creating a savings account. You're not getting that additional business that you might get if you have a conversation or two with them. So big IMBs, right, that are working with, yes, 100%. Full digital across the board. We allow them to do that. But when you look at these banks and credit unions that rely so much on these relationships, they are more hesitant because they want to maintain that for good reason.
So Marina, the last webinar that you and I did was on margin compression. And we talked a lot about automation and technology because it's a big factor in preventing that margin compression. So can you talk a little bit about your perspective on automation and what it could potentially bring?
Sure. That's one of the items that we actually track in our study is what loan origination system are you using? Are you using the consumer lending platform? Are you using a a platform specifically designed for HELOCs, or are you using the mortgage origination system? And for the first, and what we have seen is a progression toward the mortgage loan origination system. Some of the LOSs have now a HELOC component to them. And so we've seen some synergies there. And it will be interesting to see whether that means, as the technology moves, whether the operations will change. Because historically, again, my study is made up of banks. The HELOC product has been situated within consumer lending, separate from mortgage. And so we do see some movement toward mortgage among some of the banks.
All right, I'm going to go back onto the road with some of my prepared questions. There is a question about shared appreciation in the chat and shared appreciation models. And we are planning another virtual event about those models. So I'm gonna head back on road, but look forward to other questions coming in. Kevin, I wanted to, as we kind of head towards the end of this panel, I wanted to talk to you a little bit about your strategy for growth in the rest of this year and in 2024. Are you planning for growth? Are you planning for declines? Are you planning to hold steady? What are you thinking about when it comes to the next 18 months?
It's funny because I actually had a budget meeting for 2024 right before this call. So my guess for ACU, at least next year, is basically staying steady where I am. To do that 600 to 700 equity lines, that makes you actually 720, anywhere between 50 to 60 a month. Closing is about $4 million a month. And again, that's just with my one team, and that's the comfort zone that we have right now. What will drive that? It really is out of our hands. The Fed's going to meet next week, and they're going to meet one more time this year after that. If they don't raise rates, we're probably going to stay steady, would be my guess, in 2024 until second half or fourth quarter. And, then you have election, of course, which could drive rates either direction, hopefully down. If they stay steady where we are right now, if they come down a little bit, what I think you'll see is some homes come back on the market because we have a very small number of homes that are for sale, which could have a little bit of a negative lean on equity lending. But if they stay steady where they are, people are still going to stay in their houses when they're my age or older. They don't want to move because they don't want to lose that 2% rate to go to a 7% rate. So they're just going to make improvements on the house and stay where they are. So I'm staying steady.
All right, staying steady at Associated Credit Union. Jackson, what about TrueLiant?
Yeah, our strategy is a lot like Kevin's. The demand and the interest is going to be there, and I think that demand and interest is going to continue to climb until obviously we see some relief on the interest rate, on the interest rate side on the first mortgages. We're averaging about 400 home equity products a month, around $30 million a month, and again, that's where we feel comfortable right now. Again, it'll move up and down, as far as production is concerned, and how we need to address other organizational needs with the dollars that are funded through the home equity line. But I think the demand is going to be there. I think it will continue to creep up. That would certainly be my projection, but I don't, like we had talked about already, we're not going to run to chase those dollars. We're gonna serve our membership and do right by them and the organization as well.
Kevin and Jackson, could I ask you a quick question, Diego, if you're okay with that? Just as a follow-up, are you talking about the commitment volume coming in or debt outstanding? Because in debt in terms of the utilization of the existing lines.
So as relates to me, I would be talking about new production, right? But as far as debt outstanding, think our unfunded commitments are shrinking. Obviously, people are starting to use lines that have been out there for a while and maybe haven't had to tap into those resources yet. We do have a fair amount of that, but that margin is shrinking.
Kevin, do you have any thoughts on that one?
I'll go along the same. It's steady for what's new coming in. I have seen an increase over the last 3 months of people with existing lines that might not have tapped it when they did them originally, but are now, say, running out of cash or have that project that they have put off that they want to do now. In what we're doing right now, we actually have a special going on for 5.9% for 1 year for those people with existing lines that have more than $5,000 available to them. That they take a draw of 5,000 or more, they get a rate of 5.9 for 12 months. Beats the heck out of 8.25 on an adjustable or 9.5 on a fixed.
All right, I had another audience question come in that I would love to go around the horn on. Just getting general thoughts on product offerings that have mandatory draws at origination. Jackson, why don't we start with you? Do you offer products like that, and what are you thinking about that product line?
We haven't gotten there yet. Right, so we're still allowing folks to tee it up for future use, so to speak. So I really haven't had a whole lot of conversations around mandatory draws. There's been some other conversations and some other exploratory, conversations and tests and seeing what's out there. But as far as our organization, we haven't gotten there yet.
Kevin, how about you?
I did that 40 years ago. I'm an old guy. So we did that minimum $10,000 draw. You had to keep it out for 12 months, or then if you didn't, you had to pay my closing costs. But here, no, we don't have that.
Craig, what are you seeing in your client base? Is this something that that's picking up interest, or what are your thoughts here?
Yeah, it's not the majority, but we are seeing an increase, and we're seeing it through our front end application portal, because you have the ability there to obviously require draws to a certain percentage, to a certain amount. We're seeing really three things. We're seeing the draw requirements going into place more and more. We're seeing draw periods shrink a little bit, right? So really only allowing a 3 to 5 to 7 year draw period. And then we're seeing origination fees increase as well, right? So you're going from, some people don't charge any origination fee, but we're seeing that standard $950, $1,000 origination fee up to 3%, right, on some of these, going pretty high. So we are seeing those three are upticking to a pretty high degree over the past 6 to 9 months.
And Marina, are you seeing anything in the research as far as these mandatory draw products go?
We don't have any data on mandatory draws, but it's a really good question to ask, because when you think about utilization at the point of origination for the 2022 cohort, it was 30% utilization. And then it was 28% for the 2021. So it's a little bit better than it was 2 years ago, but sometimes it's just sort of tacked on and forgotten about. And so there could be improvement there from the current 30%.
Yeah, it's also the mix between, like Marina said at the beginning of the conversation, between clients that are portfolioing these loans and those that are going outside, right? So if they're going to a JP Morgan or Goldman or someone like that, and they're selling these off, obviously the requirements there are a little bit more strict, right? Mm-hmm. So they are having to do things like charge origination fees to make money somewhere up front, right? And then also they are requiring some kind of draw initially up to a certain amount. So if they are selling these off, then you're seeing more and more of that required draw.
And I can add on top of that too, also, Diego, like one of the reasons we haven't gotten there from a mandatory draw perspective is we have a lot of debt consolidation conversations with members and leveraging this loan type to solve that problem. People are really understanding now, what 20, 25, 30% interest does to them. And we're really working hard to educate our members, on using that asset that they've worked so long and hard to have. Let that go to work for them, and even in an elevated, equity rate environment, we're still able to solve a problem, save a lot of money on a monthly basis.
Yeah, that's really interesting. All right, we're heading towards the finish line here, getting close to 3 o'clock Eastern. Craig, I'm gonna bring it back to you. Beyond improvements in time to close, which we talked about pretty extensively during this virtual event, what else can the First Close platform offer to a lender that wants to either push into home equity or expand their home equity presence?
Yeah, I think it's the collaboration within all our customers to work really together. I mean, just what Jackson and Kevin, what they've kind of spoken about today, and the collaboration that they've had. There's a lot of that, right? It's safety in numbers, right? So coming to the First Close team, just from a knowledge perspective within our customer base of knowing where the market's going and where they should be. And then beyond just time to close, it's scalability. And we talked a lot about how people are leaning in or leaning out or staying neutral. But if you have the right tools in place, and that's First Close and that's other third parties as well, then you don't have to make those decisions so one-sided. It can be a little bit of hedging here and there, and you can scale into certain areas or just volume in general by opening up your buyer's box, by just leaning a little bit more in technology, right? Saying, we can do more, not with more bodies, but because I have a tool that automates when certain things are ordered. So it's not going to cost me more to do this, right? So obviously when you do that, other things come into play, like, origination fees and things like that, to make sure that you're still doing what you need to do and making money for the company. But that's the biggest thing. It's leaning on third parties like First Close and others, like I said, to then become scalable and be able to shift based off of where the market's going.
Okay, speaking of some of those other third parties, how do you integrate into a lender's existing platforms like their LOS?
Yeah, so it's twofold. For some of our customers, it's bringing in the applicant through our application, pushing that data into the loan origination system, and obviously decisioning based off of that with what products they're ordering. But in the case of Jackson and Kevin within their companies, it's the back end ordering. It's the ability to order within the LOS from those third parties, not leaving the system. So it's secure, collaborating with those vendors via that LOS through First Close and that integration. And then the data and documents pushing back into the platform after the fact. So having that kind of single source of truth within the LOS, but then leveraging some of the gaps that maybe those LOS platforms might have.
Now, we have two credit unions clients of yours on the panel today. So clearly you work with credit unions. Do you also work with IMBs and other kinds of lending institutions?
Absolutely. Yes. I mean, if you do a home equity line of credit or a HELOAN today, then we work in that space. That's what we do. So whether it be IMBs, banks, credit unions, obviously you have some brokers getting into the market too, trying to understand how to do it, how to make money through it. It's during this lull in first mortgage, people are finding creative ways to still stay busy, right? So we're helping a lot of people through this transition.
100%. And we just dropped a link into the resources section, which gives people more information on how they can get in touch with you about this, about all this stuff. But could you just tell folks here live, what's the best way to reach out to you in First Close?
Yeah, marketing@firstclose.com, or just visit our website and that will send you to the appropriate person on our end.
All right. Well, this has been awesome. We did some prepared questions, and then we went off road for a bit, like we expected, because there were lots of great audience questions. Marina, thanks so much for talking about the report. Kevin, Jackson, Craig, thanks for joining in on the panel. And thank you to everyone in our audience for joining us today. Just some quick housekeeping. We will be editing this video and we'll have it available on demand within the next week or so. And it will go on the same page where you registered for this webinar. Again, thank you so much to everyone on this panel, and thank you to everyone in the audience, and have a great day.